So we have higher than expected inflation data, but who cares? Jerome Powell just says it's a bump in the road. So Fed Fund Futures is still pricing in 3 rate cuts this year. And the market loved to see the dot plot as it ripped up higher to all-time highs once again. This brings the market into a state of extreme greed. So where do the opportunities lie in the markets? Well, we're going to talk about that on the Stock Market Brief Show today, where we navigate the financial market through the lens of technical and intermarket analysis. Just a PSA, I'm going to be doing my live streams here on YouTube coming in April. If you want to catch my live stream tomorrow, you can watch me on Twitch and or Twitter, where the last stream we had over 1,500 people tuning in just on, X. Let's go ahead and get into today's show. All right, people, welcome back to the show. We'll go through all of these charts. We have quite a bit. We're going to go from kind of the bigger kind of overall view snapshot of the market and then hone in to be a little bit more tactical, as we typically do on these shows. If you like this type of content, make sure to subscribe to the channel. Now, the policy rate, we stayed at 5.25 to 5.5. There was no surprise there. That market was pricing that in. And going into May, they're saying there's a 90% probability that we're going to do the same exact thing. It's when we get into June that we're starting to see the probabilities of then the Fed cutting rates. Now, he had mentioned that, saying that the inflation report could just be a bump on the road, so we have to see how it goes on the next report. Now, if we continue to get higher than expected data for inflation numbers, perhaps then the Fed has to then say, oh, okay, I thought it was a bump in the road, but clearly it's not what we have been stating, it's transitory or whatever. So then we had to see how he kind of positions himself after that point. Remember, the goal is to get inflation down to 2%. Now, it doesn't mean he's going to start cutting rates at when it gets to 2%. He had mentioned that he's going to be cutting rates beforehand, but he needs to see that continued improvement. And as you can see here, we're floating. I mean, we came down a little bit, right? We came down to 3.8 from the previous of 3.9. This is core inflation. The goal is 2%, and then consensus had a 3.7. So we're still at a relatively high if you just look back to the left of the chart, but we are somewhat making progress. If we take a look at the yield curve, the 10-year and 3-month, this is where we stand at the current moment. And if you just look back when we've had yield curve inversions, this is the most deepest and one of the longer yield curve inversions that we have had. And we really don't see market volatility until we uninvert. And typically when we uninvert, it's around the time that we actually start cutting rates. As you can see here, the Fed funds rate is down on the bottom of the chart. And you can see that when we start cutting rates, the yield curve starts uninverting. When we start cutting rates, the yield curve uninverts. And now we're talking about June being the place where we're going to start cutting. Now, what happens if the yield curve uninverts and we start cutting rates? Well, if you look back through history, it hasn't been all that great, right? We've back over here, this was the going into the pandemic, right? This is kind of a one-off. Let's go back a little bit further. 2007, right? We had the financial crisis. 2001, right? With the dot-com bust. Prior to that, over here, okay, in the 80s, and then we had the recession there in the 90s. Okay. Now, what are all these pink lines on the screen? The pink lines are just actually showing that a lot of people, like during these times, right? You see that there's always potential risk, right? But you don't actually know what the risk is until the event occurs, right? You can kind of forecast and guess, but that's the problem with risk. It's not about predicting what the risk is. It's more about preparing for what could potentially happen. And as we're standing here right now, right, these pink lines are representing that every single time that we had this yield curve inverted and then uninvert, we were at all-time highs. It's highlighting the times that we're at all-time highs before seeing some market volatility. So as it stands right now, yield curves inverted, and the market continues to press higher like it has in the past. So the party ain't over as it stands. You can see here, actually, when we inverted the 10s and 2s, you can see that when it goes deeper into inversion, it actually helps the S&P 500 out, right? Deeper into inversion helps out, deeper into inversion. These are things that I've shared prior in the past. I'm just revisiting it. You can see deeper into inversion, it helped out. Then we started uninverting here, and the market stalled out. Then we started moving higher. Why? Well, the yield curve was uninverting once again. Inverting deeper once again. So if it starts to begin uninverting and we start cutting out here in the middle of the summer, maybe later, we don't know yet. We'll see what the data says. Perhaps that could bring in that volatility to the overall markets. But as it stands right now, the market is on a one-way train and it's been kind of straight up like so. Kind of reminds me of Apple back in, I think, 2020. 1 into 2022-ish kind of range. I'd have to pull up the chart, but it had just this monster trend, and we really didn't start seeing volatility in Apple until the trend broke. So we'd be paying attention here closely to the 5 EMA, the weekly 5 EMA that continues to trend up. Now we are in a state where we're back into a fear and greed index and looking at extreme greed. This typically does mark periods of consolidation or pullbacks in the market, but I wanted to point out that we've actually been kind of pulling up in here multiple times. So we've been hovering around a pretty extreme greed state. Now, if you don't know what this is, they use, I believe, 6 or 7 different metrics to really determine this specific indicator. So they look at things like price, the stock price strength. So they look at net new 52-week highs and 52 weeks lows, which is at an extreme greed state based off their readings. You look at McClellan Volume Summation Index, which is stock breadth, right? That's an extreme greed stance. And then you have put and call options. They're looking at the 5-day average put to call ratio here, and you can see it's in a greed state. And then market volatility, they look at the 50-day moving average, and they have explanations of what each of these do, but this is more at a neutral state. But we'll come back to, actually, I'll just talk about that right now, actually. If we take a look at the volatility index, we talked about it on the prior episode, and I just find this to be very interesting as the Bollinger Bands, you can see, are contracting, and we haven't seen this contraction, right? We dated back, I don't have the entire chart with me right now, but it hasn't been this tight since 2007. Prior to that, it was like coming out of the .com bust, actually, and then it was like 2003 or 2004 where volatility was finally subsiding and the Fed had stepped in. But right now, right, as we know, markets move between periods of expansion and contraction, back to expansion, back to contraction, and we're in a period of contraction, and the lower volatility band here, the Bollinger Band, is at 11.85, where we just came down to 1292 on the VIX. So perhaps if we do come a little bit lower, that could be a potential level to pay attention to, because it may find a period of where we can potentially bounce from. But as you can state, as I'm pointing this out, just remember, volatility is both plus and minus, right? Volatility means you can have strong moves up, you can have strong moves down. Typically, what we've seen, if volatility expands to the upside in a strong fashion, it does put some pressure on the S&P 500. So something to just continue to watch. There's also like safe haven demand, where they look at the difference in the 20-day stock and bond returns, and that's currently at an extreme greed state. And then they also look at the yield spread, junk bonds versus investment grade, which is at an extreme greed stance there too as well. What else is on the news? We did have Apple, the DOJ sued Apple over an iPhone monopoly, and Apple did get hit pretty hard today. Overall, though, if we take a look at a snapshot of the markets, it fared fairly well today, as you can see the percent change on multiple products. And if we look at a year-to-date basis, you have up in the lead, you have Bitcoin or BITO. Semiconductors is up 30% on the year. XLC is up 12%. Then you have financials that have been doing just absolutely like astounding. And even some of the names in financials today, like Goldman Sachs, had a massive breakout of a consolidation. 10-year yield is also up. So perhaps we're seeing some strength in financials. Perhaps we're seeing strength in energy because we're seeing the 10-year yield rise. And then you have the SPY up at about 10% here. If you take a look at the day performance between U.S. sectors and factors, I did find it interesting that we did see a pretty large move in skew. So perhaps this is traders reaching out for protection. This is on the back of a falling VVIX, right? So volatility is coming off, and the VIX fell off there too as well. And then towards the top of the range, you had the Kospi. Hang Seng even was up pretty fairly well on the day. If you look at the 11 sectors that make up the S&P 500, there was only one that was down on the day, and that was utilities. And overall, we had a decent day. Small caps led the way. A lot of the index products started off with a monster gap up, following through of the dovishness from the Fed, but when we actually ended up closing towards the lows of the day in things like technology. If we take a look at the 11 sectors, this is the SPY, but we'll take a quick look at the absolute perspective of the candlestick charts. And I'll just quickly go over this, but XLC, right? XLC is breaking out of this base right here, right? So perhaps we look for a back test. Technology came to its upper end of this range, and we closed at the low. So we'll see if this pulls back a little bit and consolidates to potentially move higher. XLI has a very strong breakout of a period of contraction right here. So remember, we contract and then we expand, so it broke out. So these are things that I don't like to just hop into and chase, but you do put them on your radar for next periods of consolidation because it's in a bullish trend and so forth. XLB is still kind of within this tight period of contraction as it stands, but it is just been trending up like all of these names for pretty much all year. And then energy is one we called out March 4th, and we noticed a rotation. Now this one I'm going to revisit because something very interesting is happening from a rotation standpoint here. But this one has been moving quite nicely from the tight period of contraction over here, and even this base breakout right down there. XLP consumer staples also has been moving pretty nicely, continues to kind of press higher here in a bullish trend when you look at the 20 and the 50-day moving average here. Now, I want to visit healthcare. Healthcare names have been actually consolidating, and they haven't seen the move like some of the others. So perhaps I'd say put this back on the radar. Healthcare has been doing pretty good all year. We have a high, a lower high, a lower high, and we have, I'll redraw that. You have a low and a higher low as it stands right here. So what we're doing right now is contracting. So you can start looking at various healthcare names or just the XLV, or if you like leverage, you can look at things like Cure, like CURE, or PINK, right? And check out those charts. That's not leverage. PINK is just a simple, I forget the exact ETF, but it's an ETF, healthcare ETF, okay? So this could be another one to potentially watch as it's consolidating sideways. We have utilities that close towards the low of the day today. Perhaps we got to wait for a period of consolidation here. And then financials has been the one that's just been kind of just a one direction, straight shot move, moving way outside of what it typically does. Right, we looked into the, actually, I'll just pull it up right now. I'll do it live because I have it on my other screen. But since October, we have moved now $10.41 to the upside in financials. And if I bring up the trade tab and I look at the expected moves of financials, so we'll do that right now. Watch this. This is like look how far, like so October, right? We're talking like 5 months or so. October, November, December, January, February, March. So about 5 months. In order to move $10, you have to go way out, right? And if you take a look over here, that's $10. We'll go to 981. We'll round down. That's December of 2025. If you want to go out further, that'd be 2026 to move $10. So we're talking like the move that this is made within 5 months typically could take a couple of years. So this to me is, I can see why people would want to add exposure, or seeing names like, Bank of America was one that was on our radar, right? That one broke out of a nice little pivot and had some follow through even today. But then Goldman Sachs was a big, huge breakout. It is up 4.35% on the day. But these aren't things that I would be necessarily looking to chase here in these specific conditions, but to potentially watch for pullbacks and then periods of consolidations. Okay, XLRE is another one to potentially keep an eye on. How this one's not really been doing much, but could be consolidating here, but not much there. I think the main one that I like right now, as far as a period of contraction goes, is healthcare. And from that point, I'm kind of just watching how everything else shapes up as we progress forward. Let's take a look at some of the intermarket assets before we hop into the indices. The dollar was on a tear today. Perhaps this brought in some pressure to one like gold, right? Had a big move up, but then collapsed on itself on the day. We'll pull that chart up. But also the S&P 500, the Qs, they finished at the lows of the day despite seeing a pretty strong gap up. So we'll continue to watch to see if the dollar continues to find strength, if that's going to put pressure on the markets. Another important one to watch is the 10-year yield. As the 10-year yield rise, it looks like it's been helping out with names like energy. We've seen oil rise, pulling back slightly. And then also financials would be another sector. It was about unchanged on the day, but well off the low. So if the 10-year yield starts to rise here, are we going to see continued kind of weakness in things like growthier names? Or if this starts coming off, will we see potentially strength come back into those names? And a reason why I say growthier names is if we looked at Qs today, which will pull up that daily chart, did finish, like I said, at the lows today, while this finished more towards the highs, albeit unchanged still. So crude oil pulled back slightly today, rather unchanged, well off the lows. So is this just pulling back after breaking out? And this is going to be an important one to watch too. Why? Well, because oil has to do with inflation, right? The higher the energy prices move, it has a huge pull on a huge weighting on the CRB index. So if oil gets more expensive, right, inflation typically goes up too as well. Now, this is where what I was talking about a little bit earlier as far as the rotation graph goes. And what we've been seeing here is a very strong move, right, in energy. This is on the weekly time frame. The last time I showed this was on the daily time frame, where we saw energy was really kind of pulling into the leading category on a different time frame. And I'm calling this out because it's been the top performing sector in the last 5 weeks, right? It's up 9.1%. And the SPY is up about 5%. And typically when you get an outperformance in energy, that's not good for the S&P 500. So if we're going to continue to get strength and it's going to continue to prove and potentially move into the leading sector, is it going to put the kibosh on this rally on the S&P 500? I think that's going to be an important one to watch. Just take a look here in 2022, how we saw the relative strength line between energy and the S&P 500 start to move up pretty aggressively. What happened to the S&P 500? Well, the S&P 500 went through that bear market in 2022. Then coming out, when we're in 2023, we saw a rapid move here in the relative strength line, and that was actually put the kibosh on the S&P 500 for that 10% correction, right? We saw in 2023. It wasn't until around here where we started getting a little bit more aggressive, or I started getting more aggressive in my own personal portfolio. And since that point, S&P 500 has been on a monster tear. I'm now starting to loosen up, but now I'm also starting to look for just high quality, low risk, high reward type trades. And as it stands right now, we're seeing a little bit of relative strength here, not quite to the extent that we've seen before, but this move up, and the S&P 500 is moving up too as well. So that correlation, it's a little concerning, right? Because if you look back through history, it's mattered in the past, just like the dollar correlations mattered in the past. The 10-year yield correlation has mattered in the past, but we're just not quite seeing it yet. But we're also not seeing what the market has done as far as a consolidation or digestion goes for the entire year. It's been one straight shot up as it stands. So how is it going to resolve itself? We got to just be on guard and be aware of that. If we take a look at copper's also just consolidating after a pretty large breakup. So when we talk in terms of inflation and we see things like copper rising, when we see things like oil rising, and then the Fed is basically saying, it's just a speed bump. Is it though? Is it a speed bump? And then what's he going to say if we continue to see higher than expected inflation? Is he going to say, yeah, we're not cutting rates here again in June? And is the market going to have to then reprice it? So it does seem like we're kind of in a pickle. Let me reiterate this, right? The market is happy because we're going to be cutting rates in June. So does that mean they're going to be unhappy if we hold them higher for longer, given what we're seeing as far as intermarket stuff goes? Then taking another step further, and you look back at the history of when we did get rate cuts, right? When you did start the rate cutting cycle, it actually hasn't really been a good thing for the markets when the yield curve starts to uninvert at that point. So to me, it's just a very interesting situation, but it's not a situation that you can just sit here and time to perfection, right? It's something that you just got to be aware of. Okay, let's continue on and let's take a look at gold, right? Gold broke out of this very nice consolidation. Today we saw a huge range, but it ended up closing more towards the low, well off the highs of the day. And these type of huge volume days can spark reversals, right? We talked about this prior volume move over here. Boom, it shot way up, but then it reversed before moving higher. So this could be marking another period of consolidation. We'll continue to keep an eye on it and see how that forms. You look at the Bitcoin to gold ratio, the rate of change, right? The Sailor to Shift tool. We had our buy signal over here and official trigger. And then over here, we had a sell signal, but no trigger. So it remained on the official buy signal. And you can see price has moved up since that point. I'm just pointing this out because we're still on a buy signal, buy trigger, but it is starting to pull off the rate of change. When it crosses below zero, then we have to get below the prior week's low when that takes place. And then that would be the official sell signal plus sell trigger. We're not there yet, but I just wanted to give you a quick update on that as Bitcoin's kind of been consolidating up there in around the 60 to 70,000 range. Let's hop into some of these indices. So the NASDAQ composite, if you managed to be on the live stream when we were going into the Fed event, what we were discussing so much was it's hard to see how the Fed can be dovish given the context of what we're moving into, but the market itself, right, is a market of stocks. They were looking very bullish. So we pointed things out like the NASDAQ composite, like a very tight period of contraction. Well, we exploded from this level, right? We had some follow through. Is it going to be a fake out? I don't know, right? But as it stands right now, it's a pretty nice breakout of a period of contraction. So we'd have to hold up around this 15,800. Yes, we gapped up higher today, closed towards the low, but it wasn't really like aggressive volume by any means. So we'll see if it pulls back, is it going to hold this support? And are we going to continue this clear trend of higher highs and higher lows? It's going to be one to watch. The S&P 500, right? We gapped up, very tight range for the day, but we did close at the lows of day, but it did break out also of this very tight, very short-term period of consolidation. So we'll see if it back tests. Now, if I look at Bookmap, which I don't have on me now, but Bookmap, even on ES, there are some big levels right down in here. So if we do come and fill those orders, maybe that holds as a level of support. If we take a look at the gamma exposure, so we were talking about the call wall here at 5,200, and it's going to be hard to break 5,200 unless traders reach out. Well, guess what? They reached out further to 5,250, and we saw a pretty aggressive move in very short fashion from 5,200 to 5,250. Now, the next thing is the main one, which there's a lot of open interest at, is 5,300. So if price continues to kind of press out of its weekly expected move, which we're currently out of, 5,300 could be the next call wall in very short fashion. If you take a look at the 15-minute time frame, we're above a rising 5-day moving average. We're also in positive gamma territory, which I believe that the let me minimize that. The gamma flip line is at 5180 right now on the S&P 500. Okay, so we're in positive gamma, right? We're a little extended here, consolidating. Could be just flagging. We'll look for a gap fill. Tomorrow's expected move, volatility came off quite a bit. So we'll see here if it comes in as expected, or we see a multiple standard deviation move on a Friday. But as it stands right now, the lower daily expected move is 519.87. The higher one is 524. And we're outside currently of the weekly expected move. So to come in here, I mean, that would just be a pullback with an overall uptrend, right? Because we're back above a 5-day moving average that is currently, as it stands, rising. Take a look at the Dow Jones Industrial Average. We pointed this out on the XLI sector, but this one also has been consolidating a little bit further, and we had that bullish breakout. And we had some follow through there. The New York Stock Exchange, so a very broad market. You can see this thing has just been trucking higher and higher. And I just say pay attention to this trend line. If this trend line breaks, that's when we can see more period of digestion, maybe a longer period of consolidation. But as it stands right now, it's just continuing to press higher. And then IWM, we broke out of this little tiny pivot and we had some follow through here. We've had multiple fake outs, right? We've huge move up, got faded, huge move up, got faded. Pretty strong move, got faded, and now we're kind of seeing a pretty strong move right there. So I would say, I think we got above that 206.50, which was the level on the 15-minute time frame. So as long as we can hold that level, I think that's a good sign. If we break down from it, I'd be a little bit more cautionary, might need more time, but it can always U-turn right back up. I want to look at a couple other things. So XRT looked very interesting a few days ago. This nice consolidation here we broke out of. So I'd say here are the top weightings in XRT, right? GPS, DKS, AAP, Abercrombie & Fitch, JWN, AEO, and so forth. I'd say you can go into these individual names and look for potential periods of contraction and see if you can catch moves that benefit the breakout in the overall ETF here in XRT. But as it stands right now, pretty strong move breaking out a very tight period of contraction, right? Contraction leads to expansion. We had one right here, even right here. So we'll continue to watch that one and see how that develops. And then biotech is one that hasn't really seen the breakout yet, but we have the pullback, right? We're kind of pulling back, flagging as it stands, and we did have a nice breakout over here. So we broke out of this, right? We're pulling back, seeing a little bit of support. So if we can hold this low, perhaps we can, look into something like XBI or IBB, or you can look at the individual names that make up this specific ETF. One other one I want to go touch into is KWEB. Now, KWEB, I'm showing you on the monthly time frame. So every one of these candles represents 1 month. And KWEB's holdings, is Tencent, Alibaba, Pinduoduo, Trip, and so forth down the list. A couple that I'm not even going to try to pronounce. But you can see here, price action has been holding this trend line on the monthly time frame. And in the prior month, we actually had an inside trading month, and we broke above that prior month's high this month. And I'm just curious to see if this does start breaking out, if we're going to start to see some stronger momentum in various China names, the Hang Seng, right, or KWEB, or FXI, or is it, FXI. And there's a bunch of other ones, like I think that there's another one called CQQQ, right, or individual names. And right, as I'm looking at this could be just a longer term, falling wedge. And if we break out, right, there's at least you can manage your risk in specific areas, and perhaps that starts a pretty strong move in Chinese equities. So that's all I got for you on today's episode, everybody. It was quite a bit of stuff, but hope it helps out. And I'll be live tomorrow morning, so be sure to follow me on Twitter or Twitch if you want to catch that live stream. See you later.